There's a good chance that when people hear the word decentralized finance, they get baffled for a second and probably have very different ideas of what it means. But we are here to explain to you what DeFi really is, why it exists, and what are the strengths and the weak spots of the concept. Hi there, crypto newbie, or maybe not so newbie anymore. We want to welcome you to the moment in history where the idea of DeFi, decentralized finance, was born. In this video, we will tell you a story through which you will finally gain a good understanding of what DeFi is and why it's important to understand it inside out. After 2009, when Bitcoin, a digital new currency, was born, and the world suffered a huge financial crisis after facing the big flaws of our centralized banking system, things were never the same again. So, DeFi. Sounds like some kind of sci-fi, right? Well, it's not. It's simply an alternative financial system compared to centralized banking on which most of the economies run on currently. Imagine a forest. Two fairies meet. One has some magical dust and the other has a magic wand. They can exchange these by themselves and there's no chief spellsmaster or bank to tell them to pay for this transaction or prevent them from doing one. There's no middlemen in DeFi. In an ideal DeFi system, there's also no fees for transactions, and transfers can happen any time of the day. So, in our allegory, the fairies could trade their secret spells freely whenever they wanted to. But how does DeFi work? DeFi is based on blockchain, smart contracts, and oracles. Blockchain is a secure technology which makes transactions happen using a network of computers in many different places, and smart contracts are pieces of code that tell blockchains how to function. And finally, oracles. What a magical name, right? These are the parts that connect blockchains to the external world and its data. All of these are things that power up DeFi. There are many ways of explaining why DeFi exists. Some people call it a millennial's way of telling the older generation that they messed up the financial system and that there's something better the young generation could create. Then there's an idea that perhaps DeFi is a non-custodial system compared to traditional custodial systems like banks. In custodial platforms, assets are actually held by the parties themselves and the number values that users see are just the representations of their assets. In non-custodial services like some true DeFi platforms, users have full control of their assets. It's worth keeping in mind, though, that many of current DeFi projects are still heavily custodial and centralized due to some technical challenges developers of systems face. DeFi exists also because there is a social and economic purpose for them. In time, they can fulfill their real purpose and become independent platforms for the public to use and carry out their transactions. After all, the cost of transactions is smaller and the payments are faster as there are no middlemen. And finally, DeFis are there to trigger network effects. If everyone starts using these platforms, there can be more liquidity in the pools of digital money, which is always a good thing for any currency to have. And crypto has a bunch of new currencies like Terra, Solana, Cardano, Dogecoin, or the most popular ones, Ethereum and Bitcoin. There are many attractive sides to DeFi which make it almost irresistible to its charms. Firstly, the DeFi world already is full of various financial products which can produce pretty high yields to users, much higher than it is possible now with depositing your money in a bank. There's lending and borrowing, there's exchanges, insurance and margin trading. More about each of them soon. So, firstly, high yields. That's an interesting and widely talked about matter. Some know and some don't want to know, but the extremely high returns investors can get are due to a particular reason. They are the possible rewards for very risky investments. Those high returns vary a lot, and sometimes it can be up to 1,000% returns for a few days, or 30% of annual returns. And the latter sounds crazy good for full-time investors. However, it's necessary to keep in mind that the high yield amount fluctuates rapidly depending on how the market behaves, how the particular token is traded, and whether it keeps its value to keep the same percentage of returns. There are several ways to earn high interest from crypto, and we will tell you more about them in this channel soon, but let's take one risky and a very rewarding example. If you would lend some of your crypto coins to some, and most probably it will not be a true DeFi platform, but rather a decentralized one with a group of people controlling your invested funds as the majority of projects nowadays are, you might lose your coins impermanently if something goes wrong. Lending out crypto to earn interest via DeFi is often called yield farming. In real life, it can also be risky to keep farms. It all depends on the weather conditions, similar to how it depends on the moods of the crypto market. Can you pick the sweet, low-hanging fruits or not? It's hard to be guaranteed in crypto space. Now, let's get back to the main topic. DeFi is attractive because you can use it regardless of your location and execute a money transfer pretty fast, 24/7, and with low cost. Let's say you live in Europe and your friend lives in North America. You can transfer the money pretty fast using a crypto wallet or some DeFi platform, basically in minutes, if you have good internet connection and pay the particular crypto coin's transaction fee, which can be cents with less popular cryptos or a few dollars up to 100 in rare cases, as it can be with when you want to transfer the second most popular crypto, Ethereum. In the traditional banking system, transaction processing, clearing, and settlement involves many intermediaries, such as an ensuing bank, an acquiring bank, payment processors like Visa or MasterCard, and payment gateway for validating and executing transactions. Additionally, countries whose local currencies are depreciating fast could also find some use with DeFi stablecoins. Stablecoins are coins pegged to a currency, meaning if you invest, let's say $1, a coin is minted, that is, an extra supply of it is created, and if you take out $1, a coin is burned in the ecosystem. So, if Jose, who lives in a country where the local currency is losing its value sharply, perhaps he could invest some of his wealth into a trusted kind of stablecoin to stop inflation eating up his money. Many positives, right? So why isn't DeFi mainstream yet? Why don't people just drop the traditional finance and move into DeFi fully? Well, there are many risks to solve for the DeFi community, and I'll tell you about a few of them. Bugs. They are often plaguing the software or smart contracts of DeFi projects. Smart contracts are pieces of code that tell DeFis how to run the service. Using code, they engrave the rules on how transactions or other kinds of operations should happen in the project, and it all becomes automated. Usually, smart contracts are written in a specific coding language by project developers and are changed either with a consensus of that developer community or a consensus of the whole project's community, depending on the terms of the contract. Smart contracts are basically a way to automate payments or other electronic nature exchanges between people. There's a well-known disgraceful story of the DAO fund, which got siphoned off millions of dollars in Ethereum due to a flaw in the smart contract in 2016, and a more recent one, the Pickle Finance hack in 2020. Or in 2021, in Poly Network hack, a white hat hacker stole $600 million worth of funds by exploiting a vulnerability in a smart contract. Later on, the hacker returned the funds saying that it was all just for fun. We bet that was no fun for the founders, but they must have learned their lesson. We won't get much more into the details here, but things like these encourage DeFi projects to involve better developers and audit their code with external auditing teams, which is great. Another bug in the DeFi ecosystem is that it is pretty easy to get yourself locked out of your funds. Since DeFi wallets work only with some special logins, that is, private keys, if you lose them, that's it, finito. And here's one more well-known DeFi world story for you. One Bitcoin owner locked himself out of a hard drive which contained his private keys and his access to 7,002 Bitcoins in his wallet. In fact, some sources say that around 20% of all Bitcoin currently circulating in the market has been locked away by similar cases like these. How sad for forgetful humans. The Ethereum founders and Ethereum is the second most popular blockchain community in the world soon want to solve this problem and create some secure ways to restore access to crypto wallets. Let's continue. There's something about governance risks of DeFis as well. Even though it's often called decentralized finance or the free open waters of cryptoners, often there are crypto whales swimming around, and they can make pretty big waves underwater. Perhaps so big that the way of DeFi platform functions changes drastically, which is probably not very desirable for common investors looking for clear market conditions for their investments. And what are those crypto whales? Well, they hold huge funds. DeFi structures are governed with governance tokens, and usually the more tokens an investor has, the more governance rights they hold. Such token whales can influence the decisions pretty heavily in any organization, and there's even an option to overtake the vast sea and change the way things function in it. What's more is that there's a problem with the oracles, which connect blockchains with the real-world data. They are also pieces of code, and so they can be manipulated. And that forges a variety of problems. For example, an oracle could be manipulated to create a flash loan. Someone could borrow you a huge loan in seconds and run away with your over-collateral paid for the loan, which would not be a great thing. Finally, the DeFi market is still in its infancy and only gaining momentum. There's still few users using DeFi apps and general people who are aware how they could benefit from using them. The market size is pretty small, and if the market experiences shrink due to some crisis, it could prevent adoption of DeFi on a mass scale. And of course, fewer users means less popularity, which could continue to reduce the number of users and slow down technology adoption. With all these errors, can the public adopt DeFi for daily use? Of course it can, but with a trial and error method. Since 2020, so-called DeFi Summer, when crypto staking was popularized by Compound and other DeFi protocols, many things have happened. According to DeFi Pulse, DeFi has experienced a 10x growth since spring of 2020. The total value locked in DeFi protocols is over $73 billion. It represents the current value of all deposits locked in the form of cryptocurrencies for lending, staking, liquidity pool, and so on. So there is a huge growth of funds in the ecosystem, but there are many risks to address as DeFi apps and projects keep developing. We want to tell you what some researchers propose for the future of DeFi. There are ideas that, to avoid any scams or hacks, there should be some institutions or bodies which evaluate the code officially before a project is released. Moreover, perhaps AI could be used to help track down some suspicious activities in the projects as the sphere keeps growing. And with this kind of regulatory direction, of course, more regulation could come from anything related to the crypto world, and DeFi is a huge part of it. Whatever comes next, we will be here to cover it in the channel. If there is something specific you would like us to cover, please comment below.